Hello everyone. As tax season approaches, Exceed Lending now is providing 1-year tax return loan program for self-employed friends for buying a house. So don't miss that out. We always compare the benefits of buying or renting, but when it comes to tax deduction, buying a house usually have more advantages, specifically in those high-cost area and with high-income group of people. Actually, rent payment cannot receive any tax benefits, but there are many expenses that can be deducted when you buy a house. If you want to know how to get a 100% income tax due credit, make sure you stay with us till the end. First, let's look at how to deduct taxes after buying a house to reduce our tax expenses and what document you need to prepare for your accountant. This includes year-end income documents such as W-2 forms from employers, 1099 forms from banks or other taxpayers, 1099-K forms from third-party payment networks, 1099-NEC forms from non-employee compensation, 1099-miscellaneous form for miscellaneous income, or 1099 INT form if you receive interest, as well as records of all digital asset transactions. Taxpayers are advised to use an electronic or paper record keeping system to keep important information in one place, making it easy to submit to your accountant. The IRS provides standard deduction to all taxpayers, so if you are considering tax deduction from buying a house, make sure your itemized deduction total is greater than the standard deduction amount. If you find that calculating individual tax deductions is too complicated or calculated deduction amount is not as much as the standard deduction, then it is recommended that you use the standard deduction to reduce your tax liability. The principal of the house cannot be used to deduct taxes, but the loan portion can. Typically, the proportion of the loan interest we pay in the first few years, like 5 years, of buying a house is relatively high, so the deductible amount is significantly high. Just providing the 1098 form when filing taxes, and that should be enough. Previously, homeowners could deduct up to $1 million in mortgage interest. However, the Tax Cuts and Jobs Act now lowered the limit to $750,000 for a single filer or married couples filing jointly. If you are married but file separately, the deduction limit for each person is $375,000. Okay, like mortgage interest, you can deduct the interest on your home equity loan that you have paid. However, you can only do this deduction when you actually use the borrowed money to pay for home improvements. And also, if you just have this line of credit and you don't use it, then you cannot deduct anything from your tax deduction. When you apply for a loan, you can choose to buy points to lower your interest rate. If you have bought points before, 1 point is equivalent to 1% of the loan amount. If you buy points to lower your interest rate, yes, you can deduct the cost of the discount point. However, loan origination points are not tax deductible because these costs does not affect your loan interest rate. Every year, local governments levy property taxes on home based on their value. After paying property taxes, you can enjoy community benefits such as parks, free public libraries, and low-cost fitness center, etc. It should be noted that this portion of the property tax you pay can also be used as a deductible item for tax purpose. If the house is used for personal residence, the homeowner can write off the property tax on their personal 1040 tax return. Private mortgage insurance is another expense that many homeowners must include in their budget. If you cannot continue to pay your loan, private mortgage insurance can protect your lender. You can deduct your loan insurance premium on your itemized tax return. When you make a profit by selling a house, the capital gain tax relief comes into play. Capital gain are the difference between the value of buying and selling a home. Suppose you spent $100,000 to buy a house. A few years later, you sold your house for $150,000. So in that transaction, you made $50,000. And if you live in the house for 2 of the past 5 years, you can keep some of the gains without paying any taxes. The rule is that as a married couple, you can keep up to $500,000 in capital gains tax-free, and as an individual or married couple filing separately, each person can keep up to $250,000 in capital gain tax-free. In other words, the example we just gave you, that person can keep the $50,000 capital gain for free. So the key is that whether you have lived in a house for 2 years in the past 5 years, which is a very important tax relief regulation, whether you can really get the 100% the refund, you better consult with your CPA. One is that necessary home improvement. Necessary home improvement can enjoy the tax deduction. Of course, the definition of necessary is very limited. For example, if you decide to upgrade a fully functional kitchen, it will not be included in necessary home improvement expenses. However, if your home must make permanent improvements to make your home's safety facility more complete, it meets the necessary requirement. This may include installing like a medical equipment, installing railings, or widening accessible residential entrances. Sometimes if your roof, you have a lot of leakings in your roof, then you have to replace the roof, and that's also a necessary improvement. If you operate a business in your residence, you may be able to deduct some of the cost of maintaining the space. Among the IRS requirement, it is pointed out that using a home office for regular and exclusive business purposes is a condition for deduction. Therefore, if you only use the office space when it is convenient or just work for your employer at home sometimes, it does not meet the requirement. In terms of the deduction amount, the size of the deduction is based on the percentage of your home used for work. Now, important tax deduction tool, here we go, is if you install solar energy, a solar panel. So currently the government offers some good policy for solar energy, and after receiving the tax credit at the end of the year for installing solar panel, it can be directly deducted from the tax you owe to IRS. Therefore, if your income is relatively high, like at 20% or more ranking for the tax, installing a solar energy for your own home could benefit you the most, as you could be paying $0 to IRS for that year's tax due. For example, a new married couple bought a house for their primary residence last year, and they installed solar energy for their home. Solar company then will give them a tax credit form by the end of the year. At the end of the year, the tax refund for the solar energy is $15,000. And they originally need to pay a total of $16,000 to IRS for the income they made. With the solar energy credit, almost all the taxes are offset. So if you haven't installed a solar panel, consider this way to offset your tax due. Owning a house will bring a series of economic benefits. As a homeowner, it is necessary to pay close attention to how to maximize the value of the house during the tax season. Although each calculation may only have tax deductions of a few $1,000s, but they can accumulate over time, bring significant tax benefits, and reducing your overall tax liability. If you are a homeowner, you should spend some time matching those tax deductions as much as you can. And if you need help dealing with some specific situations, you can sure find our contact information in the video description. And we will refer you to a reliable CPA accountant for free to ensure that you can make the most out of it. Thank you for watching. If you like our video, please subscribe and share with your friends. We want everybody who can benefit from our video, especially right now it's tax season. We want to help you to save dollars. We'll see you next time.